Well, welcome everybody to this live stream on how convertible notes work. Uh, the uh, the idea here, of course, is we posted a video on this topic about a little over a week ago, and hopefully you've had a chance to take a look at that. And today is an opportunity to ask questions. And what we let's see. Oh, and by the way, I encourage you to go ahead and post your questions in the chat box, and go ahead and start that anytime, and we'll start to get to those questions here shortly. Meanwhile, let's see here. Here in the OTBC video studio, I'm Steve Morris with OTBC, here with Ernie Bootsma with Ada Wynn, and to our right, you can't see, but Jim McCright also with OTBC, who's monitoring the chat room. Like to also thank both the Oregon Entrepreneur Network and TIE Oregon for helping get the word out on this event. Quick intro. Jim and I are with OTBC, Oregon Technology Business Center. We're an incubator for startup companies in Beaverton. And one of the things we do is each year we pick 5 companies to make investments in, $25,000 each. And just wanted to mention that we will start that process or open applications for that at the end of August. So please keep that in mind as we get closer to the end of August. If you're an early stage startup that could use some mentoring at OTBC and a $25,000 investment, that's certainly an opportunity to keep in mind. And I'd like to turn it over to Ernie for a quick introduction too.
Thank you, Steve. As Steve said, I'm Ernie Bootsma. I'm a partner with the law firm of Ada Wynn. Ada Wynn is a firm that works with business clients, and I particularly work with startup companies and emerging growth companies, helping them form their companies, set their capital structure, raise capital, and then on the back end of their life cycle, help them get sold when it's appropriate time. So in terms of working with convertible notes, working on many convertible note rounds at any given time.
All right, very good. So this whole approach we're taking today is a little bit of an experiment. We posted the video with the overview of convertible notes, and I suspect a lot of people saw that and said, well, that's good enough. But we also wanted to have this online opportunity to ask questions. So what I'll try to do now is just take just do a really quick overview of what we did cover in the video, and then definitely we'll open it up for questions. So again, if you have any questions, please don't be shy. Go ahead and start posting to the chat room. And meanwhile, let me shift over here to just run through the slides real quickly. Again, of course, the whole idea. I left it at the end. I have to go back up to the top. Of course, the whole idea is a convertible note is basically just a loan, but it's a loan made with the intent that it doesn't get paid off. It actually converts to stock. And we ran through 4 categories of the typical terms: the financial, conversion terms, investor rights, and others. On the financial side, of course, key terms of any loan: the amount, the closing date, the maturity date when it comes due, and the interest rate. But then unique to this kind of convertible note, the conversion terms for an automatic conversion, an optional conversion, and then an acquisition, which isn't really a conversion, but the other way that the note gets paid off. And the automatic, of course, happens on some trigger investment event, and how it converts to stock in terms of how much money it pays per share depends, of course, on the discount and the cap. We ran through in the video a simple example to make the arithmetic easy: $5 million valuation with 5 million shares. So again, just $1 a share, and ran through so suppose you have a 20% discount and a $3 million cap versus a $5 million valuation. And of course, in that scenario, ran the numbers, and using the discount, the holder of the note would pay 80 cents a share for stock, as opposed to the $1 that the Series A equity investors would pay. But if you use the cap estimate, it's 60 cents a share. So of course, the investor would go with the lower price per share. Now, if the cap were higher, you'd get to the point eventually where the discount is a better deal, and they'd go for that. but again, just a simple example to show how the price for the note conversion is determined. And then went through, of course, the optional conversion. When you get to the end of to the maturity date for the note, and it comes due, of course, the investor could call the loan, extend it, or do the optional conversion at whatever price is specified in the note document. And then, of course, the acquisition option is the other option, where really commonly you get if you get acquired before the note converts, then like a 2x return is very common. Jim, do we have a?
Yeah, we have a question from Bill. How do caps get established? Is it just negotiations?
I guess I'll take that question
Yeah.
first. Most frequently, it is negotiation, although a lot of times, because a convertible note round is a financing mechanism that's driven by the company can at least make the first offer. So a lot of times we'll put together an initial term sheet for a convertible note round, and then my advice to most clients is socialize that with potential investors first, and see what sort of feedback you're getting. And if, for example, you get pushback on a valuation cap, we decide that early before we start preparing all the documents for the actual investment. So there is some negotiation that might occur even at that early term sheet stage. And I guess the other piece of advice I would give to my clients is you want that cap to be set at a value that's attractive to the investors, but it also has to be at a value that the company founders feel comfortable with. In other words, they have to assume that if, in fact, all these notes convert at that cap valuation, they would feel comfortable that's a valuation they intended to receive. So there is some balancing between the two factors right up front.
Okay, and also we had a question from Russ. You used some example amounts for cap and discounts. Now, how have the cap and discounts varied over the past 5 to 10 years, and why?
That's another good one for Ernie. He sees a lot of deal flow.
So I would actually say 10 years ago, I didn't see valuation caps at all. So
It's
that's
a fairly
the
new thing.
first big change. It's probably in the last 5 years in Portland. I think maybe 6 or 7 caps have become more common. And then I think over time, I would say they've remained relatively stable partly because the financing valuation mechanisms for a Series A haven't changed. So a typical Series A valuation, $5 million to $7 million, I don't think it's changed all that much in the last 20 years. But so then the caps are going to fall usually below that amount just by some degree.
Okay, and then the last question here on caps. What happens if the valuation is lower than the cap?
And that's an easy one.
Yes.
And basically, then the cap just doesn't enter into it. The conversion for the note is at whatever pre-money value is established in the round. The cap, essentially becomes irrelevant. So if there's a discount, which there typically would be, that will be the thing that will typically kick in then to give the note investor a little better deal.
Just to cover technically the language, so the language that appears in most convertible promissory notes says that the investor receives the lesser of the discounted price, so the number of shares divided by the valuation, that's the discount, or the cap valuation. So again, it's always looking to the lesser of.
All right, so looking at, let's see, other things that we covered. Slides back here. Let's see, talked about, in the case of an acquisition before the note converts, again, there's typically, a very common term would be just a 2x return. But again, it could be anything, depends on what you negotiate.
Yeah, I think I'd throw in one other sort of flavor of that I do see is sometimes that's not just acquisition prior to repayment of the loan. It might be acquisition that occurs, let's see, how does that work? I want to say so that there's a window that's applied to that acquisition. So it relates to the maturity date. Again, I'm trying to think how this works, and I'm struggling here. My apologies. So in other words, if the company is sold and your maturity date isn't for a period of time, it could trigger that payment right at the time of the sale transaction.
Mm-hmm. So again, yeah, different. It's clearly a unique situation,
Yes.
which we actually had once here at TBC, where yeah, we had an acquisition occur before the note had converted. So it's a quick
And
return.
we have another question there. Have you seen terms that go longer than 2 years, and if so, under what circumstances?
You want me to take that? Sure. I have seen longer terms. So again, that's a negotiated issue. And I think the investor's view of the world is that if the term of the note is longer, then the discount is probably deeper. So there's a relationship between the discount and the time in which the parties expect the note to occur. And so part of that maturity date issue will be driven by what are the milestones of the company. So in other words, if the company can adequately describe to the investors that we think it's going to take us 2.5 years to accomplish our milestones, it may make more sense or be reasonable to the investor to give a maturity date that's 2.5 years out instead of 2 years or 18 months. And again, that's part of that discussion that the company is having with the investor. So the company should be clear, what are these proceeds being used for? What milestones are they trying to achieve? And can they be achieved in the time period that is the maturity date?
Being really clear on milestones is always a good idea in any funding round. Would you say, Ernie, though, that 2 years and more is relatively rare?
It is relatively rare. I think most notes I see are 18 months or 2 years almost across the board. And then I have seen a few go longer, and it's usually the entrepreneur wanting to be a little more aggressive, and they'll have some reasons, like I just described, why they think the milestones are going to take longer to achieve. And it could depend on the type of company. So, for example, I had a client or have a client that is more of a research and development, cancer drug type company, and so the maturity dates were longer to begin with, partly because the expectation was this is going to take us many years to get to the next milestone. And so again, there was an understanding of that from early on, and so the investors understood it as well. Now, what can happen and what happens most typically is you'll have an 18-month or a 2-year period for maturity, and then if, for example, the company hasn't met those milestones, then there's, as I think in the video Steve talked about, a renegotiation of that date. There's an extension of it in most cases.
We have another question here about the discount range. And what are you seeing recently in Portland, and does it vary by the type of company?
So I would say I still probably most commonly see 20% in probably more deals than not. I have seen 15. I've seen all the way up to 30. But I'd say 20% is probably 60% of the deals. 25, maybe another 20%. So that's 80 to 85% of all deals are going to be in that range. And again, it's probably more driven on that length of milestone, which does relate to the type of company. So I guess there is a correlation between
and to the degree of risk. Would a higher risk be a
correct? So
discount?
And again, how do you assess that risk? And it depends on the marketplace that you're in. Maybe it's a marketplace that requires quick entry, and so short-term notes make more sense. And maybe there's a lot of risk due to that, so there'll be a greater discount.
We have a particularly interesting note we use for our startup challenge, which actually starts at 20% and then over time ramps up to 30%. So you see all kinds of combinations.
And I think that particular model was used by Angel Oregon and other sort of local organizations in their investments. Is they use a model where it says that the longer the term goes, the higher the discount will be. And so there's again a direct correlation built right into the document from the beginning.
Bill was asking what about stacked notes at conversion?
Assume that means just you have multiple notes and then a conversion happens.
Yeah, so I guess, is that a question about multiple kinds of terms, or I'm not real clear.
We're just a lot of notes converting.
Yeah, so that's actually very typical that you'll have a lot of notes. So, for example, I'm looking at a cap table right now, and we're looking to do a seed series preferred for a company. And so the analysis is I start a spreadsheet with all the notes, and I think there's like 10 of them in this particular company. All the issue dates, all the interest rates, all the caps, and we kind of run out what is the current balance as of a certain date. how many shares does that turn into? And so we're doing an analysis of that. And I guess the only issue with notes is the more you have, that table just gets longer and it just becomes more difficult to manage.
And it's a little tricky to keep track, or it's easy to lose track of how much investment are you getting in this round.
That's
how
right.
How much dilution will you get? Because you thought you were doing, say, $1 million investment, but then you have $500,000 in notes that are converting. So you're really selling a lot more stock.
And
than you thought.
that's a great point. Again, if you thought you were raising $1 million, but you have a 500,000 in notes, but then they also get a discount, so you've got to have room for shares as though you were selling $1,750,000 or some larger number. So your dilution ends up being greater than you originally expected. The more notes you have, so you just want to start managing that early on.
And of course, it's possible for each of those notes to have different terms. To have a different discount, a different cap, a different whatever, in which case, again, life is just a little complicated in keeping track of your cap table to make sure that you can track exactly how each note will convert.
And generally, that's a good point. We try to advise our clients that in any one offering, so the board approves an offering, we have set up terms, we go out and talk to investors, we try to keep everyone who invests on the same terms. And this allows for us to manage those issues. And then there's a securities question. If you, in fact, change the terms for a later investor, the question becomes, should you offer that prior investor the better terms? And technically, I don't think you have to, but it's one of those situations where if they feel like they were not told that better terms were available, they may have a rescissionary right. So again, the best advice is keep everyone in the same offering under the same terms. And so this does create some management of the offering that is required by the company.
And a little sales task too for
That's
the,
right.
For the entrepreneur. But by the way, this whole question of losing track of, on the one hand, for the entrepreneur, of how much dilution they're getting, but also from the investor's point of view, well, how much of the company am I getting is not at all clear. That's something that the second version of the SAFE, the Simple Agreement for Equity, tries to tackle by basing the investment not on the pre-money value, but on the post-money value. We'll get into that in the next topic, the next video, and the next interactive session. So more to come up on that.
And Corey's asking, what are some of the things that new entrepreneurs should watch out for or be aware of when negotiating a convertible note?
The gotchas.
Yes. And I think we've already touched on a couple of them. I think valuation cap is very important. For example, I had a recent note offering in which we had a bunch of notes with a valuation cap of $1 million. And then the company starts seeking a Series A at $7 or $8 million, and even has some investors looking at that valuation. And the disparity was so great that there was no way, the note holders were getting such a large portion of the Series A, none of the Series A investors would invest. So it actually, in effect, destroyed the deal. And so, again, having that valuation cap set in a reasonable place that's going to be at least close to what we think we're going to be getting in that hypothetical Series A round or seed series preferred round is important, because that gap can cause trouble. I think what other issues bring problems?
Another, this is a little bit of an obscure one, but is the liquidation overhang issue you can get into with a cap. If you have again, especially if it's a particularly low cap, so that the note is buying shares at a very low value, down the road when there's an acquisition, that investment round that caused the conversion will typically have very commonly a liquidation preference, where maybe the investors get 1x of what they invested. And by the way, we'll go over this in a concrete example for the SAFE, because the SAFE has the same issue with the cap. But the Series A investors would get their money back, and then they would convert to common and participate with the common. Well, the investor with the note that bought the note for just a fraction of the price of the Series A investors, they might get a multiple of their money back. which is generally seen as being a little too rich. And in fact, the SAFE is structured specifically to deal with that problem by giving you a slightly modified version of a Series A preferred share. And again, we'll go through an example of that. But that is another thing to be aware of for a note. You can, from the entrepreneur's point of view, you're getting them, well, in terms of an acquisition, a lot more of the money goes off the table to the investor before the entrepreneur gets to participate. So that's another thing to be careful about. Again, more concrete example in the next video.
Okay, Dawn is asking about different triggers for automatic conversion. What happens when, in the absence of automatic conversion, if a note holder refuses to convert to equity?
So that's a good question. So most standard notes that I see around Portland have dual triggers. So one will be the automatic conversion. You do a price round at a certain level or higher. That's the typical automatic conversion. And I think the point that was just raised by the question is in the conversion where it's a choice by the investor, that often only occurs after the maturity date, and often it'll be into a valuation that's predetermined. I always call it a fallback valuation. A lot of times it's set as your cap valuation, so it's like a worst case scenario that after that maturity date, the investor can then trigger their conversion of the note into that predetermined valuation. So again, it makes that cap valuation negotiation important. You know, the one issue that I've been seeing on a couple of occasions lately is what happens if the note holders want to convert earlier than the end of the maturity date. And most notes do not provide for that alternate conversion opportunity to occur before maturity. And so I had a case recently where all the investors wanted to convert, but there was just no ability to do so. And because of that, some of the founders were able to then maintain control of the company and really drove it into the ground. Whereas if the investors had been able to convert, they might have been able to take over the company and do something with it. And so it was really an uncomfortable situation. But that is something I would look at. When is that optional conversion triggered? Because it could be that the company is willing to allow optional conversion at any time at the valuation cap. That is a possibility. Again, these documents can be written in any way. And so having that discussion with your legal counsel and trying to decide what does that make sense before you draft the documents.
But if a note holder refuses to convert to equity when the maturity date comes up, then I mean there's only two other options, right? I mean the note is called or it's extended, you know, in a negotiation, and one of the two. I mean, without an extension, you know, the note comes due.
That's right. And that actually does raise an interesting point. A lot of convertible note rounds, and most that I do, will provide that the notes can all be amended by a majority vote of the note holders based upon the amount invested. So if you do have some professional investors who are the majority of the note holders, and you have some individuals who don't really understand their rights, the professional investors with a majority could vote to amend the note to either trigger a conversion or to take some other action. And so again, the problem with having it be unanimous would be that you could have a situation where one person just withholds consent. And then in that case, just like Steve described, maybe they may call their note where everyone else wants to convert.
So again, pick your investors carefully.
Yes.
So they're hopefully reasonable to work with. Let's see. I think it's like we're running out of questions in the chat room. I think we summarized a fair amount of what was covered in the video. I think let's see if I run through that a little bit more. There's we went through, of course, we just talked about the optional conversion. Oops. The different rights, the like typical information rights, maybe the right to approve big decisions, board observer rights, and pro rata rights are very typical rights that you might see incorporated into a convertible note. The pro rata, in particular, you know, the right to once your note converts to a certain ownership in the company, and the right in future rounds to co-invest with those future investors to maintain that percent ownership would be pretty common. One suggestion there that didn't mention in the video, but is to maybe be careful about pro rata rights. You can always set a threshold for the pro rata participation that says, you can get the pro rata participation in future rounds, but only if you hit a certain amount of investment. That gives the entrepreneur a way to encourage investors to invest a little bit more, to do a minimal amount of investment. And at the same time means you'll have fewer pro rata participation rights to manage in the future. Because again, it's another thing that just adds complication to figuring out the cap table projection, but then also the actual cap table as you do more rounds. So it's another thing to keep in mind as you're negotiating a term sheet, that you don't have to give pro rata rights to everybody.
And again, I just would be clear in that term sheet what these rights and who they apply to. So again, it's back to this issue. You want to have these issues spelled out. What are the thresholds? What are the differences for investment? If you invest more than $25,000, you get a pro rata right. Have that clearly spelled out so that the investors all know what the expectations will be.
We have a couple of more questions here. How much definition of what happens if the note passes the maturity date is typical?
So most notes will basically just set the maturity date. It doesn't say anything about collection or the note becomes due, other than it does trigger the optional conversion sections of the document. So the optional conversion sections will then have, as we talked about, that fallback price, that have the right maybe for the investor to just elect to convert. So it's really a decision of just one or the other. They have the right to convert under that optional conversion provision, or they have the right to demand payment. And again, I think what the general wisdom is, most note holders don't expect to receive payment, because again, a lot of these companies have received the money, the time period is gone, the money's all spent. There's not really any money for them to be repaid. So optional conversion is the primary sort of outlet for them.
The next question is interesting from Bill. Is it fair to assume the cap should be approximately equal to the valuation at the time the note is made?
If you had a perfect crystal ball and knew what it was
Yes.
going to be, that would be great. But that's the challenge.
And that's actually one of the ways I try to start having a discussion with clients is exactly that. If you were to go out for this hypothetical Series A round, seed series today, what would be the value that you think you could get or justify, would be appropriate? And then we start setting it from there. Now, if the value ends up coming down a little bit, maybe that's okay. But again, let's just take as an example a typical Series A in Portland might have a $5 million to $8 million valuation. So if you were in that $5 million range, that's probably not too far off. And that's setting it today as opposed to waiting till the end of the 18 months or 2 years maturity. So,
yeah, and again, setting it too low and then getting a very high valuation, that can cause some of the issues that we talked about before. So that can be an issue. And it's maybe good to explain that issue to investors too, because it's also a problem for them.
yes. So that's actually back to picking your investors, because to the extent that investors are investing in a number of notes in various companies, they do start to understand the negative impacts that the valuation at a cap can have on the company, which creates issues for the investors in the long run. Because really, you want these investors to feel like they're joining the team and working with you to create the fewest problems possible to impede the company's growth. So again, working through some of those issues in advance makes sense.
Well, Don's asking if, from the investor perspective, how do we avoid triggering lender liability issues by asking for too many rights, such as approving hires or expenditures?
That's a good question. I have actually not had that issue come up very often. In most note rounds, we don't have too many restrictions on the company. I think Steve notes in the video, for most note investors, the best they often get is board observation rights and information rights. So it's more sort of passive. It's receiving information. It's not actual control over the company. Now, once you get to that Series A round, the amount of money that's raised starts to support those later investors' rights to participate in the company, and they may have more of that potential liability. Note holders are usually less so, partly because, again, let's talk about the scale of a note round. We haven't really touched on that too much, but a note round really should be like 250,000, 500,000, that kind of range, so that when you do your later Series A round, for example, that it doesn't overwhelm the amount that you raise. This amount that you raise in the convertible notes needs to be sufficient to meet milestones. So I've actually seen note rounds go as high as $1.5 million. I saw one go to $2 million once, but it does start to create issues. One, of too many investors, and then too much that'll get converted. Now, if you have $2 million in notes, maybe there's one or two note holders that have 500,000 of those notes. Maybe they do want some of those controls more like a later investor. But again, I don't think that's a very typical situation.
Yeah, the typical would be maybe at most observation rights on the board, probably not voting rights on the board. And yeah, in theory, you could have like veto rights of major decisions, but I've never seen that in a smallish note at least. But,
yeah, like a protective provision, because
yeah.
One of the first things that a Series A investor asks are protective provisions, which are really the right to vote as a separate class on particular issues like sale of the company or raising more capital or something to that effect that's a major decision, and then those investors that have the right to vote separately as a group, and then you'd have to have a majority of them approve those transactions. And so those protective provisions are common for later investors, not usually for notes, but I suppose if the note round were big enough, it could be negotiated. I just would be very careful about it.
What about the right to review dividends or salaries to the founders if they receive the money from the investors and then at their next board meeting vote themselves large bonuses from the investor money? That would be of a concern, obviously, to the investors.
I think that's a very good question. Most note rounds that I'm aware of, they place very few restrictions on the use of the capital. In some ways, the investors are letting the entrepreneurs make the decisions to use the capital in any way they need to, including paying salaries.
And in general terms, like it shall be used for the operation of the company, and nothing more specific.
Now, I've seen some restrictions on you can't pay yourself, you can't pay back old loans. So in other words, the investor doesn't want this new money to go out to pay back a prior loan, maybe even to some of the founders. I've seen those restrictions that would be negotiated into the note purchase agreement. Again, those kinds of restrictions, I don't think you're starting to border on lender liability if you're placing reasonable restrictions on the use of your own money. And again, if they're fairly narrowly tailored, then I probably would say to my client that's probably acceptable, because again, if you're wanting to raise the money, sometimes you have to give the investors what they need in that circumstance.
Probably one of the key controls over the company doing unreasonable things in terms of paying themselves huge salaries is that if they do that, it'll be pretty tough to raise that next round of funding, because they've shown that they're not really taking care of the investment very carefully. It's not being fiduciarily responsible. So there is ultimately that control that they have to work on.
And not trustworthy maybe to use those funds to really achieve the milestones that they're seeking to, that they're indicating that they're going to be achieving. Because that money is more likely or better spent probably hiring new tech people to get a beta or an alpha or whatever, hire new marketing people to start growing your customer base, that kind of thing, as opposed to paying the founder's salary.
My advice is always to the entrepreneur that, hey, it's in your best interest to keep the salaries low, because whatever your milestone is, it'll probably take longer than you'd like to think. And you need to stretch that last round, that convertible note, farther than you wanted to. So running out of money is not fun. So keeping salaries low is one way to stretch that money as far as you can.
Yeah, I think the general rule of thumb I like to tell people is that it'll take you 2 to 3 times longer to accomplish the milestones, and you'll need to raise 2 to 3 times more than you think you're going to need to raise. So again, if you start having that mindset, then you're really back into saving that money and using it wisely.
Don asks, so how often do you see convertible notes with a security interest? We saw that recently with a company which made it very hard to get other capital into the company until that investor with a security interest converts.
Yes, I don't actually see that very often. I have seen it a few times, so it's not wholly unheard of. It partly depends on the types of investors. Again, if they're sophisticated angel investors, they're doing a lot. They know that that has a negative impact on the company. Now, the one thing that could mitigate that is you could have a provision in the documents that says the investors get a security interest, but then it'll be subordinated to any commercial lender of the company or other types of outside lending sources. So they end up taking a second position after the primary lender. So that would be one way to balance that effect. Again, I don't see it that often. Now, it could be sometimes a note that's secured by IP. So sometimes patents might be the way that's covered. I've seen that a few times in the past. But again, it's not as common as you would think.
And Michelle's asking if you receive some family funding personally to use to start the business, can you use investor funding to pay that off?
Well, that's, I think, the point I made earlier. Usually later investors do not want their money going to pay off family loans. I think the better way to approach it would be to take those funds, grow the company so you're starting to increase revenues, use the revenues to start paying back family members. That's probably workable. Again, as long as the sort of payment plan is within the company's pro forma budget, and again, everyone's advised of what's happening, but that generally doesn't happen. In fact, most family money I would actually more often see come in through the convertible note round itself. Actually, so that's often how startups work. Is the day they come in, they form. We got a founder team, then they go out and do their first notes. The first note holder is going to be Aunt Joe. And then okay, we've sold a couple notes for $75,000, $100,000. We're starting to make a little bit of progress. Now all of a sudden we can go talk to some of the local angel groups, and they join in as well. That seems to be the most common sort of scenario.
But your pitch to those angel groups then is that we need more money now to accomplish new milestones to move the company ahead, not to pay loans from the past. So yeah, that's a very tough pitch to an investor. They want to invest money to move the company ahead.
Yes, agreed.
And Don mentioned here that you saw the whole note round go to over $8 million, which is a little too much, which I think relates to your earlier comment.
Yeah, really, really difficult to raise the next round of money. And what I've actually, so then what I get involved in is how do we clean up that cap table for the next round? And so sometimes what you do then is you go back to all those note holders and you say, let's convert all of you now, just by unanimous approval of these people who are majorities, convert them into a Series A round that's run by the company. And then really what you're going after is a B round from the next investors. And those note holders have all been moved to their own security, not a note. It's sort of cleaned it up.
All right. Let's see. I think we're running out of questions, and I think we've covered actually most of the turf that we've covered in the video. I think. Let's see. We talked just to wrap up what the video covered. What are the advantages of doing the note as an early stage funding round? And at least a couple of them are your valuation. You're putting off your valuation, which means in the future you'll be worth more. So when the notes convert, that saves ideas that will save a little bit of dilution for the founders. Also, a convertible note is just a much simpler. It's a lot less to negotiate. You can do it faster. It's less legal expense. It's just a more practical way to do a small round of funding. Any other advantages you would note to?
Yeah, I think that's the main one. And again, if you can justify in your mind that, say, for example, you have a 20% discount, that you can grow the valuation by more than 20% with the money you receive in the note round, then it's well worth it. So that's a huge advantage. And Steve's right, the legal costs and the time to prepare this, run in the thousands of dollars as opposed to the tens of thousands, which you might spend on a preferred stock financing. Because the preferred stock financing has a whole, another level of documentation, from new articles to investor rights agreements, and just a whole stack of documents, whereas your note is basically a purchase agreement and the note itself. It's a pretty simple set of documents. So I get a lot of clients coming to me and form the company and do the note round all within the first couple of weeks, and so it can be done quickly and really cost effectively.
Now, there is an attempt to reduce the cost of one of those more complicated priced equity investment rounds is to use some standardized documents like the Series Seed, and we'll tackle that one actually in the third video here in this series. In terms of disadvantages or drawbacks, anybody who favors the safe at least would have to point out the maturity date. This idea that sure, for the entrepreneur, there is that maturity date that's coming, so that's kind of hanging over your head.
So the interest component might be the other one.
Yeah, there is an interest component. Yeah.
So for example, some older notes, and I don't see this very often anymore, the principal amount would accrue interest, and then the investor would waive the interest in exchange, and then they would just get a discount. Most notes that I see today are, you get, let's just say you have a $100,000 investment at a 10% interest rate. It goes a year. You've got $110,000 value now because you get $10,000 of interest. That $110,000 will buy you stock in that next preferred round. So the interest is actually converted into more stock.
Plus, then there's probably a discount.
Plus the discount. So that's a drawback in the sense the company is paying more to you, to the investor. Whereas in some of these older notes, which I don't see very often anymore, is again, they just waive the interest, which is closer to what the SAFE does. There's just no interest component.
Mm-hmm. One of the questions I know that we hear from first-time entrepreneurs is, do I have to personally sign a note and guarantee it? Have you ever seen that occur?
Actually, I've never seen that in a startup. Again, I don't put anything past any investor because every investor has their own view of the world. And if some individual founder has the wherewithal and personal wealth to do that, maybe they might be asked to. But I think it would be very rare. Most of these are notes issued by the company. So then sort of keep in mind, when you get to the maturity, that's back to the investor doesn't usually expect to be repaid because, again, that money's been spent. There's no personal guarantee. There's no collateral. It's really a placeholder just for later equity.
In other very early stage debt instruments, you often do see a personal guarantee requirement, like microloans. They typically would require that, or really any loan that you're going to get before. What a banker usually wants to see at least a couple of years of revenue and an established history, so that you can convince them that you'll pay back the loan. And anybody that'll loan you money prior to that probably will require some kind of collateral.
That's probably why you're paying 10% interest and a 20% discount. I mean, part of it is because it's uncollateralized and has no guarantee. You have to offer these investors something, some upside long term for their investment of their money in your company.
And the fact is, the investors are taking risks. I mean, clearly investing in startups is risky, which is why experienced angels tend to invest in a portfolio, because they realize that not all of their investments will make it. In fact, probably a majority of them won't return much, or little or nothing potentially. So yeah, that's why the investment is in a portfolio, and it's why investors look for the potential for a lot of return, because they realize that these are very risky and a lot won't return much, if anything. All right. I think we might be running out of questions. I think we covered some good ones.
We did. I'm just looking at my notes. I think we even covered all the questions that we had for ourselves.
That's right. I think we covered all the questions that I made up just in case we didn't have enough questions. So that's great. We do have coming up next will be, and I think that should be out within a week or so, is a video on the SAFE, the Simple Agreement for Equity. And we'll cover, in fact, I may have to split it into two videos to cover both, because the original SAFE, which is the best known, but then the newer SAFE, as it was modified in 2018, which focuses on post-money value instead of pre-money value, and that's a very different ballgame than the original SAFE. So that's what will be coming up next in terms of video and another live session for Q&A. And again, after that, to wrap it up, the Series C to give an example of the price equity. So I think with no more questions,
Or should we stay? Do we have more time?
We do have one more time. We're not
Yeah,
we're not at 1 o'clock yet.
happy to stay and take more questions.
Yeah, if anybody else has another question, we're certainly game.
We get questions here at OTBC about what's a reasonable amount to seek either in the first round after friends and family versus later stage going to the angel funds. What are you seeing in the Portland community right now about
The
reasonable
typical first.
ranges of financing?
For some reason, the number 500,000 just comes to me a lot, just because a lot of companies, if they can raise or open a round that's 500,000, and that's a good question. The way we do this is the board basically authorizes a note round. So the board approves the company selling promissory notes or convertible promissory notes up to a certain amount. So the minutes will say up to 500,000. The great thing for the company is you don't have to sell that many. You could sell 100 and stop. You could, and then come back to it a month later and sell more. So again, it has some flexibility. So I do often see that a number like 500 to begin with. And the great thing is the board can amend that and change it. So a lot of times in the terms of the documents, we'll provide that the maximum amount can be amended at any time by the board. So the investors are put on notice ahead of time that the board can raise that number. So again, it's again flexible.
At the same time, it comes down to a kind of a strategy question for the entrepreneur of why do you need that much money, right? I mean, it always has to be focused on a particular milestone. It has to make sense.
Yes.
And yeah, realistically, if you're a very early stage company and you're trying to raise as your first round $1 million or $2 million or more, that can be tough. But especially if it's not clear what exactly you're going to accomplish with it. On the other hand, if it's, we need 300, 400, 500, whatever the number is, and with that we will accomplish X, which will make us worth more and prepare us for the next round where we'll be more valuable. That's the kind of story that tends to make more sense to an investor.
And that, again, is always driven by the type of company. So I just think if you're a product company, for example, you want to raise enough money to get prototype, or maybe it's enough to have the first run of the product produced so that you can deliver a sales order to a large customer, and then you can start showing traction, because that will show a greater valuation. So again, the money turns into a milestone, which turns into a greater valuation. So again, you have to really look at the type of business you have, and again, where are you going to increase the value of the company? And sometimes that's just hiring more people so that you can increase sales and show that you've got a sales pipeline that's increasing. So again, you just have to do some self-evaluation, I think, for that.
Yep. And it has to make sense just in terms of a one step at a time, from an investors. To leap out to a several $1 million round as your first funding round, probably not an effective strategy. So, and that's something you can test with some investors too, to really explore, for your stage, for what you've accomplished so far, what really is a sensible number from the investor point of view.
I think really, if you're thinking about Portland or the Oregon market generally, is that investors here require a lot more customer validation before they start making investments. So again, you probably want to raise enough in that first round to get the product launched, and so you can start showing that customer validation. Until you can do that, it's going to be hard to go to a fund or an angel group to raise money, because most of them are going to say, go back and get customer validation first.
And even initially for that very first round, customer validation in the form of at least customer discovery is almost certainly going to be required. But people have to have confidence that if you build it, somebody's going to buy it.
Have you had cases where companies have, at the maturity date of the note, have paid off the note and didn't need to seek any more financing if they've been successful at that point?
Yeah, most of the notes I go out to the investors with, we have a term in it that says that the company cannot repay the note without the approval of the note holder, so a majority of them.
And if they're doing well,
and it's primarily for that reason. In other words, it's not fair to the investors to have taken all the risk and then be forced into just taking their money back plus basic interest and not getting the discount. So it's rare, But sometimes if you get to that maturity date and the company has a bunch of cash and you've got individual investors who just have lost sort of faith in having their money keep rolling, I have seen some paid back in those circumstances, but it's usually more of a one-off.
Yep. And I think we have no more questions from the audience, so I think we can go ahead and call it a wrap. Again, stay tuned for the next session and the next video. We'll have lots more to talk about with SAFE. And aside from that, thank you very much to everybody.
Thanks to Ada Wynn and Ernie
Thanks to Ada Wynn, and thanks also again to OEN and the Oregon Entrepreneurs Network, and to Ty Oregon for helping spread the word on this. And we'll see you next time.
Thank you, everyone.